Hi, everybody. Welcome to this session on finance and insurance. We're going to be starting in about a minute and a half.
Hey, Redley.
Hi, Marco. Is that Marco? Great. All right, I was just saying we'll start in about a minute, everybody.
Sorry, I'm late. I'm stuck with my neck. I have a terrible pain, so.
Oh, sorry to hear that.
Yeah, it's okay. It happens.
Yeah. So I think we actually I think the live stream's already started, so we can. We're asking if everybody could turn off their video and audio until we present. And just in terms of run a show for everyone, we have 6 presentations, which will each run 12 minutes in length, which will give us time, hopefully about 15 minutes or so for Q&A and discussion after the presentations. Okay, well, I'd like to officially welcome everyone to, I think, a really exciting session today on finance and insurance issues related to managed retreat, resilience. Like so many things in this conference, I think we'll find that all the material we'll hear about is of relevance and related to managed retreat, even as some of it simultaneously exists and is applicable in a lot of other domains that at least historically we haven't necessarily associated so much with managed retreat. So we will have 6 presentations of 12 minutes each. And without further ado, I'll get us started by turning it over to Andrew. You have 12 minutes starting now.
Thanks, Radley. Thanks, everyone. I'm going to share screen here. All right, should work. Oop, that's on the wrong slide. There we go. Okay, Radley, it's looking good. I can't see it, but if you could.
It looks great.
Awesome. Welcome, everybody. So thanks for the opportunity to present. My name is Andrew Kruczkiewicz. I am based at Columbia University at IRI, also part of the Red Cross Red Crescent Climate Center, and going to talk a bit about some ongoing research that I'm collaborating with Carolyn Hultquist, who's based at here at Columbia, but at CESIN, the Center for International Earth Science Information Network. And yeah, so Carol and I, we started working together on this, coming at it from different angles. My background is meteorology and disaster risk reduction. Carolyn is a geographer, geospatial specialist working at the intersection of many different spaces. And in the past couple of years, we've been asking a lot of questions about floods, flood risk, and that has led us to think much more about access, availability of mitigation and insurance and other programs to address flood risk and different types of flood risk. So clearly, there's been a lot going on in this space. I mean, that's one thing that Carol and I both discussed. We're not the first ones to be thinking about these questions. So we thought it was important to start off by saying there's a lot going on. Many, especially recently in the past few years, people in research groups thinking about questions such as who is benefiting from flood insurance and flood mitigation programs, especially at the national level. To what extent can the benefit be analyzed using existing data and available data? Some really good work going on to explore questions such as that. And then, especially in the past couple of years, what can be done to ensure environmental social justice is integrated into flood insurance and mitigation programs. So this is very encouraging to see this. And again, as people, as newcomers to this space, kind of trying to bring in different elements to the discussion, it was really valuable to see what was going on and see how what we could contribute to the discussion. We also note that the larger discussion, I shouldn't say larger, but the general discussion of flood insurance programs and fairness has been discussed for quite a while. There's work back to 1974, where there's discussions about how insurance and mitigation efforts were initially designed to protect financial institutions from significant losses, not necessarily focusing on protecting the most vulnerable people, and not necessarily focusing on underserved populations, for example. These discussions are present regarding these programs here in the US, but also abroad. The third section here is talking about in the UK, thinking about fairness as social justice within flood insurance in the UK. And there's also examples here from Hungary and New Zealand as well. So again, thinking about this idea of fairness and thinking about how to build off work that's ongoing, and thinking about specifics of, from my perspective and my interest, different types of floods, different subtypes of floods, flash floods, riverine floods, coastal floods, and also thinking about how the risk of those individual subtypes and also on compounding subtypes is currently expressed and currently captured within these programs, and also how it's going to change over the future. Are these programs, such as national flood insurance programs and mitigation programs, are they flexible enough to capture different types of floods and also compound events is one of the motivating factors. And to dig a little deeper, we focused on some research questions that definitely build off, again, what is ongoing, but trying to create a slightly different angle. So right here, what can we learn from studying environmental justice at various spatial scales to understand who is benefiting, and what data would we need to assess fairness and ensure environmental justice? So again, also a message to the community here, we are interested in working on this, and this is one example that one of our explorations where we focus on the Carolinas. So why the Carolinas? Well, there's significant flood risk, particularly in coastal regions, many low-income areas, pockets of wealthier, mostly white communities. And the pictures here represent different types of flooding that happens in different parts of the Carolinas. On the top right, this is a picture of the Outer Banks, and you could see this narrow strip of land, and we see storm surge, in this case, overtaking the narrow strip and creating inundation in a much different way than what we see, such as the picture in the middle or slightly left of center on the screen, which is a picture from kind of like the Piedmont area, the highlands of Western North Carolina, where we see more of a riverine type flood, a river bursting its banks and inundating this park area. And in the bottom left, the picture from Columbia, South Carolina a few years ago of more a flash flood, maybe quasi flash flood riverine event, but in an urban area. These are all different types of flood events and events that happen across the Carolinas. This map we chose to put here is a map of FEMA declarations in the past, I believe this is 30 years. So we could see that there is higher concentration of FEMA declarations of disasters, flood disasters in the coastal area. However, we do see events happening all across North and South Carolina. So we focused on two elements to kind of explore a little bit more about distribution of flood insurance program benefits and mitigation activity benefits. We looked at the FEMA Hazard Mitigation Assistance Grants programs. There's 3 current programs, but there's also previous programs captured in this data set, and the data ranges from 1989 to 2020 at the county level. It's also available at the zip code level, but also speaking to the importance of understanding spatial scale and choosing the appropriate spatial scale, we chose to analyze this at the county level. And we were interested in looking at non-coastal and coastal counties in terms of the type of mitigation activities, and also within coastal definition across shoreline and direct Atlantic Ocean facing counties, which are more specific than NOAA's more broad definition of coastal. And here are some plots of the mitigation activities over that period of time. And the top left, you can see the Carolinas, and you will see the darker colors are counties that have the higher number of properties in which mitigation activities were undertaken. And we could see that there is a higher quantity along the coastline and coastal defined areas, but we also do see a distribution across the central and western parts of the Carolinas as well, likely due to different types of floods, not coastal floods as they are inland counties. On the bottom right, we see a time series of North and South Carolina both, and we could see that we have a fairly consistent number of mitigation activities with a few spikes over time, especially in the late 1990s there. So what did we do? So we used the NOAA coastal definition to better understand what is the number of mitigated properties in the Carolinas. And then we broke it down using the NOAA definitions of coastal counties with shoreline, coastal counties without shoreline, coastal counties with direct Atlantic exposure, and then coastal counties without direct Atlantic exposure. We understand that this is county scale, so it is a large scale, but we wanted to better understand where were the mitigation activities taking place. And you can see the distribution there below. However, we also felt it was more appropriate to look at the particular type of mitigation activity. So demolition, acquisition, floodproofing, elevating properties, acquiring vacant properties, and reconstruction. And we could see, if you look across the NOAA more broad coastal definition, there is a difference between the different mitigation activities. And as you look across the county types, we also see a difference not only per mitigation activities, but also as you look across, as we move across the different types of counties. And on the bottom right, there is a link to the NOAA definition of county types. So I not only have a couple minutes left, but I also wanted to touch on our work with flood insurance. So the National Flood Insurance Program, there's also a lot of activity, a lot of research being done on this. Over the past, the data set that we used at the census tract level, and from 1975, this is available in the Carolinas. And we were interested in the disproportionality impacts, especially considering race. Looking at the difference in disproportionality in census tracts versus counties. So I'll get into that on the next slide. This is the total NFIP counts per tract. And we see that there is a distribution of higher values of count per tract along the coastline. However, we do see inland, especially some bright spots in urban areas where we see higher color, let's say darker colors, indicative of higher number of NFIP claims, especially in some of the larger cities, such as Columbia, South Carolina, moving north to Charlotte and over to the Research Triangle area, Raleigh, Durham area there. So, but we were mostly interested in questions around access and availability and benefits from NFIP. So here we created a map of the disproportionality between census tract and counties in terms of either majority, or basically answering the question, is each tract majority white or non-white, and how is that relative to the level of white or non-white per county? This was an approach used by Elliott et al. in 2020 on a more broad scale, but we decided to look at the Carolinas to better understand some of the dynamics. And we see some patterns emerging here about, we'll see the darker oranges and red indicate more non-white tracts in white counties, in the darker greens equal more white census tracts in less white counties. When we plot this along the tract disproportionate minority, it's on the x-axis here, as we move to the right, we see less minority population in the tract than county, and we move to the left, we see more minority in the tract than county. So we see the distribution here of the number of claims in the county, which is on the y-axis, and we see it is skewed, which indicates that as we have more minority in the tract than in the county, we see a larger difference than if we move towards the less minority in tract than in the county. So again, this is speaking to the challenges in access and availability of these programs and pointing to the importance of better understanding how we could move from more research in this space and thinking about more monitoring and evaluation of the current programs and thinking more about shaping action in practice in developing programs that are sensitive to these differences. And yeah, we believe that the Carolina case study is an example, and we hope to build off this further. So anyways, I think we're up there. I'll leave it on this slide, but otherwise over to you, Radley.
Thank you, Andrew. Gave us lots to think about. I know one question has come in already, but we are going to hold it. But we'll, as I said earlier, we'll have about 15 minutes for questions for everybody at the end. So with that, let's go to our next speaker. We are going to hear from Swenja Surminski from the London School of Economics. She'll be talking about designing a funding framework for the impacts of slow onset climate change, insights from recent experiences with coastal retreat.
Yeah, hi, thank you very much. Very exciting to be here. And, you know, just sort of reflecting on the fact that this is a session on insurance and financial instruments, and I spend basically 95% of my time talking about insurance, but actually today I'm going to spend less time talking about insurance, but more about general sort of questions that arise from, well, what we call planned relocation, which is kind of, managed retreat, just another terminology. So yeah, very excited to be here, and I'll give you a few overviews or sort of insights from recent publications. This is based on collaboration with Jonathan Boston from New Zealand and my colleague Akitesh Panda, who was until recently with us at the LSE and who's now at MCII, the Munich Climate Insurance Initiative in Germany. And, you know, we're sort of, giving you a few insights from this research, and it's underpinned by our own sort of case study and experience working across different geographies. So, you know, there are some insights from recent developments in New Zealand, India, and then I've also currently engaged in some work here in the UK. So I'll give you a few insights from that. We're also currently working on a book chapter that sort of picks up some of these findings with a strong focus on coastal change, and you know, that being a case of what slow onset sea level rise and coastal erosion. Let's see if I can manage this here. Okay, so just to give you a little bit of an overview, and sorry about the awkward formatting here, so you have to kind of read while I'm talking. So let me just open it up. So this paper that we've just published focuses on, well, we use planned relocation as a terminology, and we can spend the next 10 minutes discussing what's the right terminology. And, you know, I'm sure all of you in your publications, you know, you spend several paragraphs justifying, you know, whether you call it managed retreat, planned relocation, or so on. Well, maybe let's leave that as an aside for the moment. So the focus is within countries, so it's not cross-country. And we're quite interested in trying to understand, you know, with that sort of anticipation that planned relocation will become a necessity in certain areas of the world, and it is already happening in certain areas of the world. What can we learn from, you know, existing policy approaches and also funding approaches? So that was really sort of our starting question, and obviously, you know, underpinned by this notion that, you know, planned relocation is very complex and challenging, but you know, as I said, it is already happening. And so the question is, why, you know, in some countries, for example, New Zealand, I mean, they've been very proactively also asking the questions, you know, how can we actually structure this, and what are the sort of governing principles that we should apply if we wanted to set up funding mechanisms. So it's very much in this spirit, so also trying to learn some lessons. And yeah, what the focus is then is really also trying to tease out some of the principles, you know, that that should govern any mechanisms around this, and fairness and effectiveness, also long-term cost minimization and distributional fairness are critical. So I'll give you a few insights from our findings. What we did, we kind of looked basically around in terms of existing funding instruments and mechanisms that have been applied. And the first notion is often these things are very much ad hoc and in response to to an event, rather than really sort of setting up a funding mechanism well in advance. And then, obviously it depends whether you're looking at, sort of highly developed countries or countries that depend heavily on international aid and grants. But we've kind of tried to basically lay out a little bit of the landscape of what it is and who pays for it. And then obviously within that, there are lots of questions about, the speediness, the reliability, to what extent, these things can actually be earmarked, or whether this is more an expectation that these funds will be actually used for relocation. And then there are some new schemes that are kind of also currently being explored or piloted. And we've kind of tried to look at this also through the lens of sort of different scales. Some of that is sort of nationally arranged, others are more sort of at a regional scale, but then you also have these community schemes. And one example there is where actually some local communities are starting to explore to what extent they can pool funds to set aside money to support managed retreat or relocation. So obviously the key question is then also who pays and how the financing is structured. And as I said, mostly it's post-event support for recovery and reconstruction. And that's, this question of where does actually managed retreat fit in? And does it actually sort of require a complete sort of different approach to setting aside funds? Or is this yet another way of dealing with both slow onset and sudden events? And I think, what our notion is generally, we are still much more sort of post-event focused than pre-event. And, if you look at overall the funding amount that goes into repair and recovery versus, ex-ante resilience creation, I mean, there's a huge imbalance. And I think that is particularly worrying in areas where we know that slow onset climate change will just make this so much more important, and where we actually, if we don't take resilience actions and if we don't take ex-ante actions, we're going to face significant problems. So it's kind of this old question of how can we actually address the balance, and shifting from, sort of this relying on post-event towards a more anticipative funding and also policy approach. And that's kind of fundamental. And I know we've just heard some examples from the US in terms of also flood insurance, and a lot of my work focuses also on how insurance can actually support such a shift towards pre-event resilience building, rather than just being seen as a tool to actually then deal with recovery and reconstruction. So we also looked at existing laws and trying to understand actually what exists in the context of slow onset disasters, slow onset events versus sudden disasters. And I think this is quite interesting because when you kind of look at the existing structures, there are a few that pick up sea level rise. There are a few that sort of focus on coastal erosion, but it is predominantly driven by the approach that we're taking to sort of extreme events and disasters. And I think that raises some questions, where this fits in, where slow changes, gradual changes, the sort of longer term nature of change also fits in, or whether we need to find new structures that deal with that. And yeah, that raises questions around predictability, but also durability of funding structures. And it also then raises the question to what extent existing structures are really suitable for planned relocation, or whether it is inadequate. So, you know, from our sort of experience looking at some of the cases and sort of working our way through that, I mean, there are some key questions that come up in terms of, you know, the balance of public and private funding, and also how to achieve the best mix of funding tools. And again, it really matters whether you see this in the context of developing countries or developed countries. And, you know, when we looked at New Zealand, when we looked at the UK, obviously there are sort of different tools that you can apply. But some of the underlying principles, I think, are actually quite similar. And in the discussion that we had also with governments in India, I mean, there are questions of, you know, also allocating some of these responsibilities between, you know, national government, regional government, and at the end of the day, you know, how that burden is then spread out, and whether actually there are pools available. I mean, the case studies in India showed that, you know, there are already huge examples of communities moving away, and there are some examples of them getting compensation or even sort of being supported during that transition, but that is all rather ad hoc, and it's not sort of really set up and governed by sort of policy structures and funding regimes. So, you know, the accommodating these sort of long-term fiscal implications, that's something that, yeah, it will require new approaches. And then pre-funding is this key challenge that we know from a sort of sudden disaster context. Pre-funding is not, you know, following the political nature, where usually after an event the money flows more freely than prior to that. So just to kind of highlight some of the principles that we've then, based on the existing experience, sort of came up with, which I think are quite useful in the context of thinking through, you know, new funding regimes in the context of sea level rise. So I think, you know, one of the key principles is, you know, how to minimize long-term societal costs. And obviously this is not, you know, this is not just limited to sort of, you know, economic losses, but with managed retreat or planned relocation, you have huge social implications, and sort of measuring that is often very challenging. Equity between generations and you know, within existing generations is important. And also, you know, the disruption and uncertainty. I mean, for many people, this is kind of seen as the last resort. But the question is whether, if you design it correctly, it could actually become a more sort of positive alternative and option, rather than be seen as the last resort. But that requires, again, planning and starting. And then integrating that with other strategies. And I think this whole question around where does this fit in with climate change, adaptation, and sustainable development in general. And we see this also in the context of, being a sort of more positive part of a strategy and offering sort of alternatives, rather than seeing this as the end of the road. And transparency, accountability, very important. And just at the end, I wanted to flag, when we revisited sort of experiences with tools, you know, there are also new approaches, and, you know, there are some examples listed here: trust fund, green bonds, some mitigation credits, or, you know, the adaptation fund and the green climate fund are currently sort of exploring, or, you know, there are discussions about using those also for planned relocation. And then lastly, insurance comes up, and I just wanted to give you a bit of insight at the very end about some of the work that we're doing, sort of zooming in particular here in the case of the UK, where we are involved in research to support coastal erosion solutions that might include insurance. And this is part of a general sort of piece of research that started with this notion: what can actually insurance do? And some of you may follow the loss and damage discourse that exists in the international negotiations, where insurance was a long time seen as a potential sort of solution. And I think it is still a solution, but with lots of caveats. So what we did here in the UK was to reflect on how insurance is currently used in coastal and also other types of flooding, and sort of pointing out where the challenges and issues are. And one observation is that the way it's currently structured, it actually sort of is likely to increase future risk and might also support environmental injustice. And then the question, well, what are the alternatives, and how could that actually be in a coastal context also be used to help with planned relocation? And this is a very exciting sort of new project. I just wanted to flex some of the sort of ideas that currently are being explored by our local partners on the East Coast, where really the question is, what can we do? How could we utilize insurance to help address, coastal change, and particularly their coastal erosion? And some of these examples here are listed, and I would be very happy to discuss them. And we're doing this in the part of a broader sort of flood resilience focus, with the notion that actually it shouldn't be seen as the end of the road, and relocation and managed retreat can also be an opportunity if it's designed correctly. And with that, I'll hand over to the moderator. Thank you.
Thank you, Swenja. Okay, next we'll go to my colleague here at Columbia, Marco Tedesco, who's going to talk to us about evidence of climate gentrification in Florida's rental markets.
I think somebody has to stop sharing the screen, otherwise I cannot share mine. Swenja, thank you. Thanks, everyone. I'll do my best. Stay within the 12 minutes. Thanks, Radley. This is a work in collaboration with Jesse Keenan at Tulane University and now USGS as well. Caroline Hillquist, you also already heard from Andrew and Alex de Sherberin, also at the season here at Lamont. Let me slightly give you an overview. What, the title, we're going to look at climate gentrification, very brief definition for those of you who are not familiar. Then I'm going to introduce you the CIFR data set, which is something we developed here at Lamont. And season, I'm going to show you results for a test case in Little River, Miami, and I'm going to go through some conclusions and future work. The climate gentrification proposition that was proposed a few years ago in a paper by Jesse and co-authors, it basically implies that the climate impacts make some property more or less valuable, and the price volatility associated with these impacts, it could be either a primary or a partial driver of basically urban development that can lead to displacement, which is heavily consistent with the conventional framing of gentrification. And I reported a definition below that. It's the most commonly used dictionary you can find anywhere, but basically the idea is that influx of middle class or wealthy people who want to renovate or rebuild houses, businesses, small businesses, and this ultimately ends up into an increase in the property values and displacement of people, usually socially vulnerable or, of course, low-income people. So we started from this assumption, and one of the things that I wanted really to look for, what I was wondering if there's a way for us to start looking at a more quantitative, spatial, robust way to identify areas, or to at least monitor areas that could be undergoing climate gentrification. One of the aspects that I really cared about was the use of publicly available data set. There is some body of literature coming up using commercial data sets, and I wanted this to become more publicly available because I think transparency is very important, and of course for climate justice and environmental justice purposes. we having publicly available data is and transparent data sets is very important. So we created this data set called SEFR, the Socioeconomic Physical Housing Eviction Risk, in which we combine Social Vulnerability Index with other socioeconomic data, House Mortgage Disclosure Act data, which includes, by the way, also data on ethnicity, gender, race, and other information, eviction data produced by Eviction Lab, the recently released FEMA National Risk Index, and we also look at rental provided by Zillow. The data set is freely available. I can provide it to you. We're finalizing some cleanup, has been accepted, has been discussed in a paper that has been accepted after minor revision. I'm more than happy to share any information for anyone who's interested in. By the way, I made a mistake here. It's columbia.edu, of course. So I'm going to talk about Little River. Little River and the test case area is located in Miami-Dade. It's characterized by a very low per capita income with a high number of rental properties, high unemployment, and a very poor education. And you can really see here on the per capita income map, it's really this line separating on the right, the per capita income. It could go up to $30,000, $40,000, $50,000 a year. With the left, we're talking about $10,000, $11,000 a year. And Little River is the district and neighborhood. The tract we're looking at now is here, and it's highlighted by the bold black line. This is a map of the elevation. Of course, this is Florida, so we're talking about a few feet, 10 feet at max changes. But what I want to point out is this ridge, which is basically separating the coastlines from inland and Little River. And also you see that this area is characterized by a very high number of rental properties with the bottom right map in this slide. What is the idea? Why looking at rentals? Of course, real estate is very important. The sales, I think rental is also very important because it's a different temporal scale. When we can really probably look at different things under the same scenarios. But what's really happening, and there's a lot of from locals, they know, and there's a lot of anecdotal information that developers are targeting inland because they're increased, and there is an increase, of course, coastal exposure of properties there. And of course, also Florida has a big problem in building new properties. There's no more land available to perform this kind of development. The high number of rental properties and socially vulnerable people make it very appealing for speculation. These areas are also often opportunity zones defined by the federal government, so they are very also appealing for this reason. And there is a relatively high elevation, which make it event shielded. So this area is becoming very applicable for this kind of things. And what's happening, what we think and we know anecdotally is happening, is there is an increase in uncontrolled exponential in the rent, which of course put a lot of financial and fiscal pressure on people. There is also an increased number of evictions. This again increase not only the fiscal burden, but also the emotional stress. And this then definitely lead to displacement, and it contributes heavily to gentrification. So we want to, as I mentioned, we wanted to use this data for something that could show at least some quantitative results to start monitoring, some early stage monitoring, detection of potential areas where this could be happening. And so we developed 3 indices. The one is a rental stress index, which accounts for the percentage of rental properties, the rental burden, and the per capita income. The second, which is a flood risk index, which accounts for riverine and coastal flood risks. And the third one, which we called the rapid displacement index, which accounts for changes in unemployment, transportation, and education. And we performed the selection of these indices based on cross-correlation and principal component analysis of the original data sets. But then we combine it with something that we call for now the climate gentrification risk index, which of course the score from 0 to 1 means that the 0 is low risk and the closer to 1 is higher risk. And Little River, it shows up to be very much one of the areas where the index suggests or indicates or it shows some inferential evidence that that this is happening. validation assessment of this is, of course, is very important. We don't use the eviction data for our indices, but when you start looking, for example, at the number of evictions, the distribution of the number of evictions in 2015, for example, for this region, you do see that, again, Little River, highlighted by the bold lines, is showing a very high number of eviction together with all the areas that are around that that place. But when you put things also in a long-term context, the blue line shows you the total number of evictions starting in 2001 through 2016, where we have the data up to then. For Little River, the orange line shows for Miami Shore, which is right north of Little River, and it's a very strong contrasting from a social dynamic and socioeconomic perspective neighborhood, which is basically most of the people are influxing and coming from there to move and somehow displace as to Little River. But you see that really there is a strong increase after 2008, the global house crisis, and then there is a peak in 2015 that is clearly symptomatic of the potential pressure and that is exerted on people living there. Again, we're talking about people living with $1,000 a month, originally paying $200, $250 a month for rent, whose rent has been increased within a year by 300%, in some cases up to $600. And they keep receiving eviction notices, and then this increases not only just the financial status, but even just the socioeconomic and the emotional and stress increases the stress on these people and forces them to move out. On the top of the graph, also you see I put the burden rate originally in Little River was about 34% and then increased to about 50% and stayed so high after 2007, 2008, but it remained mostly constant for places like Miami Shore. I had prepared another slide, which I have no time to show here, but bottom line, what you see here is that Little River is characterized by very heterogeneous multifamily, single family, and commercial areas. And the future plan is to, of course, so to say, populate the tract with single family, relatively expensive places and condominiums. I wanted to present to you one example of an evidence that this is happening now. This place is called Magic City Innovation District, and I'm pointing out where it's located in the context of the area of Little River, which is the pink part. It occupies 1.5% of Little River. It's about $1 billion investment, and developers are mentioning that they do all the best to account for the local culture, which is basically mostly Haitians, Caribbeans, and Hispanic and African Americans, to incorporate into their projects. But of course, the pillar upon which the entire development is building is the eviction of people who are, especially mobile homes in this case, who have been in Miami Rose area, who've been evicted by the uncontrolled and continuous increase of rent. The landlords, they sell to the land to developers, and they keep doing so they can have enough room to move forward with this. And of course, this is one of the biggest push for gentrification in this area. I wanted to briefly, in the last 30 seconds, give you a summary. We think really the open data, especially financial housing data, which is now very absent from the conversation, is very important for climate justice and to study climate gentrification. That's why we created this data set. It's publicly available. I'm trying to put it somewhere where people can grab it. We're still not at the stage, but I'm more than happy. We're very close, and we're more than happy to share with anyone, especially those who are working with communities, advocacy, locals, and other people. The indices that we proposed are capable of monitoring or at least detecting areas where this could be happening based on the combination of displacements, flood, physical risk, and the rental. And the rental is very important because it really is one of the driving mechanisms. And finally, we applied this to other areas. We identified the regions in Tampa, Fort Lauderdale, Jacksonville. We are very close to submit another paper to look at these areas. And we really encourage the community to reach out, to collaborate, and use our data set. This concludes my presentation. And thank you, Riley. Thank you, everybody, for listening.
Thank you, Marco. Great. Okay, so now we will go to a couple of joint presentations, I would say. So we have a combined 24 minutes for the next two presentations, however you want to split up the time. We are going to be hearing from Mónica Serrano, my close colleague who I enjoy working with at Turner Construction. They're at the forefront of resiliency issues, as we'll hear. And also presenting will be Mike Gudas from Liberty Mutual Insurance. They'll be talking about insuring our future, resilient buildings, and insurance.
Great, thank you, Ratley. Can you hear me okay?
Yes.
Excellent. So just as Ratley said, Mike and I will speak on resilient buildings and insurance. And just a little bit about myself, I'm a mechanical engineer by trade. I lead the resiliency program at Turner Construction Company. I've been in the construction industry for 17 years, and I'm currently pursuing a certificate on sustainability analytics at Columbia School of Professional Studies. I truly consider climate change to be the biggest threat to humanity, life as we know it, and things we value like health, welfare, and equity. My presentation will include a little bit about the resiliency journey of Turner, observations from the construction industry, and we'll then dig into resilience and insurance. Just a little bit of fine print. This presentation won't focus on community resiliency. It is not because we don't consider it important, it's just simply because of the nature of our work. I truly believe that increasing community resilience is essential, as we can build the most resilient building to natural disasters and whatever disruption. But if its surroundings are not resilient, the building won't ever be fully resilient. So with that in mind, a little bit about Turner Construction. We have been around for about 100 years. We have 45 offices in the United States, a couple of offices abroad. In the United States, we have about 5,000 employees. Our New York City office and headquarter office is on Hudson Street in New York. We build anything but bridges and roads, even though we have sister companies that build bridges and roads. So potentially we sometimes partner with them and build bridges and roads. But the most of the scope of our work includes hospitals, schools, stadiums, data centers, airports, community centers. Our clients are both private and public entities. For the last 13 years, Turner has been named the top green building contractor by the Engineering News Record, which basically just means we build a lot of green buildings. And because we're a large company, that makes sense. And since the beginning of this century, we have built a lot of LEED buildings, because that's when LEED got created. But a few years ago, we realized that if we took those green buildings away, we didn't have much left in terms of sustainability. And by the way, I am talking about sustainability because the resiliency program lives in the sustainability program. So anyway, a few years ago, when we realized that we needed to do something more than just building green buildings, we took a close look and started developing different initiatives, such as our Turner 2030 commitment, which basically means we're going to reduce our carbon emissions during the construction process by 50% by 2030. We also have developed services around carbon embodied calculation and reduction. We're piloting solutions like electric equipment in our job sites. We're growing a sustainable culture in our operations. And the resiliency program, which, as I said, lives under the headquarters sustainability department, got started about 3 years ago, when it was obvious that some of the effects from climate change are just irreversible. And we basically have to, step up to the plate and build better and smarter. Our resiliency program is focused on mainly three things: the buildings we built, our operations, or how we built, and our people. We're conscious of the fact that people are our best assets, and not only our Turner staff, but also our construction workers and partners. And if all of those folks are not ready to adapt to changes, we're not as resilient as we can be. And so our resiliency program so far is a lot about education, about what resilience is, what adaptation is, how resilience and sustainability are different, even though there are many synergies. It's about coming up with ways to advise our clients on building better and showing the value and the ROI of resilience. It's about learning how we can assess and address climate risk in the most efficient way, from how it affects our job sites, our workers, our supply chain, and our legacy through the buildings we leave behind. COVID and most recent supply chain interruptions are definitely accelerating resiliency efforts, I would say, across the industry and not just at Turner. In our company, we're evaluating our supply chain and making programs to improve supply chain resiliency. We're also evaluating potential disruptions and risks and coming up with plans to respond and adapt depending on the disruption. Some of our clients are asking for resilient buildings. We have built about dozens of resilient buildings, not a dozen, but a couple dozens. And I'll just show you a couple of them. So this is the Oklahoma University Medical Center in Oklahoma. This was the second building in the US to follow the RELI pilot standard, which is now it's a comprehensive certification for resilient buildings. And again, it's called RELI. This building can operate independently for 4 days after a disruption. And this is the Connie Island Hospital, currently under construction. You can see, I'm sorry, the picture's a little grainy, but you can see that the ER is on the second floor, which is not common practice. And the critical equipment is also elevated in the 5th floor. During the construction phase, we installed a temporary flood barrier around the entire perimeter of the building complex. And we elevated the temporary electrical service with concrete pillars. These are simple solutions, but not widely implemented yet throughout the industry. And talking about the industry, I wanted to spend some time sharing some of my observations in the construction industry in the last couple of years as it relates to resiliency and adaptation to climate change. So these are some of the players in the real estate industry. And, as we know, we're not at a point in history where there's a mandate that we all assess and address climate risk. Building codes are not up to date to address future climate risk. Neither we are at a point in which we all value assessing and addressing climate risk in the most effective way. So here's where I think we are. Investors, lenders, and some developers, emphasis on some, are assessing the climate risk of their investments and developments. Some designers, architects, engineers are assessing the resiliency of the buildings they're designing and they're engineering, and they're aiding clients with solutions and mitigation strategies. Now, it's important to point out that ultimately clients are the ones making the decision on implementing those solutions or not. Most construction companies are using insurance as their only climate risk mitigation strategy. Insurance companies are paying off our ever-increasing claims, and I'll let Mike elaborate on how insurance companies are feeling and reacting to the increasing natural disasters. ROI from resiliency is not fully being valued yet. There's some studies, limited out there. NIBS has created a very comprehensive one, ULI, and even insurance companies have published some studies. But it really depends on the client, how long, it depends on who the client is, it depends on where the building is, it depends on how long the client holds on to the building for, and how much risk they're willing to stand. It also important what the building is used for, right? Is it a data center? Is it a hospital? Is it an office building? My view is that all of these players are catalytic, some more than others, to what will be built in the future, where it will be built, and how we will build it. But as we know, this is not simple or a fast process. It takes every member in the construction industry team to address climate risk, to consider more ambitious solutions, more ambitious decisions. In the meantime, I believe it's the right thing to do to discuss climate risk and bring it to the table to come up with different mitigation strategies, including discussing questions like, is this the right location for the building? Is this the smarter way to build? And all of those decisions will soon start affecting things that we value, like even as businesses, like our reputation and our legacy. So I'll now tell you a little bit about the relationship between resiliency and insurance as it relates to our company. So I mentioned most construction companies use only insurance to deal with our climate risk. So we have an insurance arm called Turner Surety and Insurance Brokerage, known as TSIP, and they have been instrumental in connecting Turner with different insurance partners. In January 2020, we held a roundtable, an in-person roundtable. Remember that? When we conversed about climate risk and climate change, which, side note, it is groundbreaking for the construction company to talk just openly about climate change, right? This was not happening 10 years ago. And so at this roundtable, we walked away understanding that insurance companies are concerned about climate-induced claims. We are concerned about the safety and resiliency of our buildings. And so we continue conversations through, this entire year and a half, coming up with ideas and collaboration projects where we can increase resiliency and adaptation, potentially designing new insurance products or coming up with studies to study the ROI of resiliency, coming up with tools to assess the resiliency of our job sites. We are far from having all the solutions, but we certainly are moving in the right direction. My hope is that the pace accelerates and that together, insurance companies, construction companies, and all the players that I mentioned before continue working towards a fruitful future, potentially in different, more livable hubs than what we're used to. I'm hopeful, again, that we're moving in the right directions, but we definitely have to accelerate the pace and collaborate, perhaps even further than just the construction industry, and with other industry, perhaps like academia. So at this point, I will pass it on to Mike with Liberty Insurance. Thank you, Bradley.
All right, thank you, Monica. Let me throw up my presentation. It should be working now. Hi, everyone. Thank you for your time today. I'm Mike Gudas. I'm a director of innovation at Liberty Mutual. Been working with Monica for the past 18 months on this topic of ensuring our future resilient buildings and insurance. I'm going to broaden it out a little bit to talk a little bit about an insurance industry perspective on some of these issues from the inside. And I think it actually ties in well with some of what Swenja was talking about earlier in the day. So first, for just some context, insurance companies can be sort of dense organizations. And so I thought I'd put a little bit of where I'm coming from in the organization. So Liberty Mutual, a large mutual property and casualty insurance company. Some of our stats are up there on the right, the key highlights. We are, there's the two main divisions to the company, global retail markets, which is personal insurance, the type of products that you might buy personally, auto, home, small business insurance, and then global risk solutions, which is more the corporate specialty and reinsurance. And that tends to be a bit more global in its scopes and operation. My role works within that corporate insurance space, global risk solutions. So I bring a little bit of more of a B2B lens to the conversation, but can definitely speak to broader insurance issues. Some interesting parts about being within Liberty, you get a very broad, diversified view of insurance globally. We interact across pretty much any key market and any product line that falls within P&C. And then as a mutual, we tend to have a little bit longer term focus rather than some of our publicly traded competitors that might be a little bit more beholden to quarterly earnings. Something that came up in the question and answer, and I was going to talk to in this is, as we've worked with Monica on thinking about what can the insurance industry do around pre-disaster activity, it's unlocked a lot of sort of what are the strengths and the challenges that go into the insurance industry and some of the dynamics that play within it. What I've noted through working and engaging on these topics is that there really is a heavy ability for insurance to think about safety and loss mitigation. That's core to the way that we approach problems and an area where we like to engage in, but it tends to get very granular on specific issues. And these sort of broader issues are a bit of a challenge for us. Loss data and experience is one of our core strengths, but then the ability to share that across industry and pool that and aggregate that, a lot of that data is considered quite proprietary and trade secret. And so that's kind of an inhibitor sometimes. The breadth and reach of the insurance industry, there's not a sector or aspect of society where insurance isn't playing some sort of role. And so the ability to operate in a very sort of systemic way is an impressive part of the operation. Unlocking that can be a bit of a challenge. And then at the end of the day, insurance is a social good. heavily regulated by public sector. So within that, there is a very good alignment, I think, with addressing some of the challenges that exist here. So the way this plays out in practicality, insurance has really been a driver in building codes, workplace safety, auto safety standards over time, and also a very heavily compliance-focused organization in responding to state and federal level regulation. Challenges that I can note exist within this is we definitely have a reactionary and short-term approach to dealing with these challenges. We have, thousands of people within claims operations thinking about how to respond and to meet our policyholders' needs in the event of a disaster. A handful thinking about how to mitigate those disasters up front. I think that's shifting, but slowly. The overall structure of the insurance market, it's quite layered. Oftentimes we're removed from our customers, and so our ability to sort of interact directly with policyholders is sometimes inhibited by different sort of layers of intermediary brokers. And then it's also quite fractured. So even as a larger player, we're talking about having only 4 or 5% market share. So that kind of inhibits your ability to operate collectively or cohesively or in a way that moves the market in a new direction. There's many structural barriers across the industry. It's just heavily regulated across many different layers. And so that inhibits, rapid innovation. There's a lot of things that need to be thought through. And then profitability and connecting the dots around that. Commercial property insurance in the US has lost $23 billion as an industry over the last 4 years. And yet we're kind of still approaching it, I feel like, in a very, how do we sort of deal on the fringes versus some of the core issues here. At the heart of some of this, insurance is built around a 1-year policy solution, and that's how we manage the business. So that can be really tricky when you're thinking about longer term scenarios and how do we adjust our business practices around this. And then even a lot of insurance is regulated at the state level, at least in the US. And so how do an insurance regulator at the state level start to take a broader role in policy discussions at a state level to start to see the true cost of risk? A good example of that is the insurance industry lost around $15 billion in the latest Winter Storm Uri in Texas, which was largely attributable to a man-made challenge of not winterizing the electrical grid there. That's something that the insurance commissioner may have wanted to have a stronger voice in up front in potentially mitigating some of that, or at least highlighting the potential risk of not taking actions on the electricity regulation side of the market. So just an example. Where we are engaging is a topic of the coverage gap, which I've heard addressed in this conference quite a bit, but the underinsured portions of the world and how insurance can engage more proactively in that. And so just an example of that, micro insurance is one approach to getting more corporate insurance solutions or different solutions out there, because insurance ends up being a pretty key recovery tool when the granular research and development around building codes, safety standards, things like that are very helpful. Enterprise risk management practices and solutions. So within Liberty, we partnered with the firm Jupiter Intelligence to think about climate risk and how do we bring that to our customers as a way to start to quantify and qualify the risks around climate. Then you can, once you can see them, you can do something about them. Working more in the advocacy and public policy stance. So we've recently joined up with the Build Strong Coalition to hopefully start to weigh in a little bit more heavily on the front end of these things in the public policy debate. And then partnership with clients when they put up the demand signal for wanting more holistic solutions in some of these areas and to explore new things. And our work with Turner is an example of that. And there, when do we need to work with academia more, kind of for this audience? There's a gap here, I think, in applied climate adaptation research. So those things that are really targeted at how do we engage the private sector of insurance in some of these areas would be really helpful. And I think, my plea to that is that insurance is a really underutilized, pretty powerful level in driving system change. And I'd like to hope that we can do that in a proactive way versus a reactive way where private insurance markets retreat as climate change impacts become more pronounced. I think it's the difference between managed retreat and unmanaged retreat. And, I don't know, that's an interesting debate for this group. climate change centric risk transfer solutions. I think there's been some chat about some of those, but parametric or index-based insurance solutions are often cited as a way of helping to manage new sorts of climate-related risk. Integrating justice into risk and insurance structures, I think that's a challenge for us and is an area where the public debate is going to feed the private debate, and what our role is in that could take cues from the public sector, but more thought and engagement and on that is definitely on our radar. And then innovative and proactive public policy solutions, because I don't think our current risk structures are going to be adequate as we go forward in this. So that's what I had for a presentation, and we'll yield back the balance of my time.
Fantastic. Thanks very much. So we're actually going to keep going because we did fall a little behind schedule, but we anticipate having 10 to 15 minutes for questions at the end. So we'll now turn to our last talk, which will be from Nori Tarui at the University of Hawaii at Manoa, talking about the effects of sea level rise on property value and managed retreat in Honolulu.
Okay, thank you very much, Bradley. Okay, gonna share my screen now. Okay, yeah, so this presentation is about the effects of sea level rise on property value and managed retreat in Honolulu. This is joint with McKenna Kaufman, Conlock Lamb, and Seth Urbanski at the University of Hawaii at Manoa. Okay, so just like many other coastal regions and cities, Oahu or Honolulu is exposed to the risk of sea level rise, and there are many properties along the coastline. So the research questions here are, does exposure to the risk of sea level rise affect the market price of housing properties on Oahu, those that have been traded in the past 10 or 20 years? The second question is, how does the impact estimate depend on the type of exposure to sea level rise, and how does that interact with other types of coastal risks? And I'm going to conclude my presentation with some implications to managed retreat. So what we find is that the housing properties subject to 1 meter sea level rise exposure risk, those are associated with about 15 to 20% discount in the transaction price. And what matters is not just the passive flooding or conventional measurement of sea level rise exposure as used by NOAA, but seasonal fluctuations and seasonal high waves. Properties that are exposed to those high wave risks, they also experience discounts. If a property has a hardened shoreline or put up seawalls, that tends to offset this sea level rise discount, but this is in the expense of negative impacts on the neighbors. So neighbors to a property that has seawalls, they tend to have a discount on their housing prices. So that indicates that coastal armoring regulation must be enforced more strictly to address this problem. And it turns out that other coastal risk factors, such as the existence of cesspools or septic tanks, that also matters in terms of how the future climate change might be affecting the current property prices already. So my colleagues at the University of Hawaii have been studying the effects of sea level rise, and their main finding is that well, a large majority of Oahu beaches are subject to the risk of erosion, and that is due not only to sea level rise, but also to the coastal shoreline hardening, especially by private landowners. So they put up seawalls, and that's going to have a negative impact on the the health of the coastal areas. So to address this question, we apply several sources of data, geospatial information on residential parcels. We combine that with GTRACS, property assessment and transaction data from Zillow. And we have rich sources of data on sea level rise exposure, both locally from Pacific Islands Ocean Observing System and the NOAA sea level rise measures. We're going to look at the residential housing located close to the coastline. So in particular, those within 0.25 miles from the coastline on the island of Oahu. And as for sea level rise indicators, we're going to think about several different definitions of sea level rise. Passive flooding, this is what NOAA's sea level rise indicator corresponds to. So you can imagine a bathtub model. So sea level rise happens, and then that's going to lead to marine and groundwater inundation due to the elevated sea level. But in addition to that, sea level rise will cause annual or seasonal highway flooding to change. So that's what this annual highway flooding sea level rise indicator takes into account. In addition, sea level rise might change the profile of the shoreline. That might lead to the erosion of the coastal areas. And this measurement of coastal erosion takes that into account. And so all those are different types of sea level rise risk is integrated in this comprehensive measure. It's called sea level rise exposure area by Pakayos in Hawaii. So as you can see, there's a fair amount of differences across different parts of Honolulu in terms of the exposure to sea level rise. So you see some pockets of areas where a large portion of houses are subject to sea level rise risk. And there's a similar study that has been conducted on US mainland by Bernstein et al. So we're going to follow their methodology and make some arrangements to take into account local conditions. So what we do is to apply econometric analysis to see statistically how the price of properties are associated with the sea level rise exposure and various housing characteristics. And the key here is that we want to make apples to apples comparison. So we're going to compare houses that are that have similar distance from the coastline with similar elevation and in the same zip code and the same type of houses, like single family or multi-family. So what's going to go into the property characteristics? Well, we have some variables that are conventionally used in the existing studies, like property size, house age, and number of bedrooms. But in addition to those, we take into account the existence of ocean view. Well, that matters a lot, the property markets in Hawaii, and several coastal risk factors. For example, a FEMA flood zone designation, whether or not the property is connected to sewage and has some sort of on-site disposal system, such as cesspools or septic tanks, whether the property has seawalls, and whether the property is a neighbor of seawall properties. Because previous studies have found that that matters a lot. There's a negative spillover effect of someone's seawalls on neighbors. Okay, so what we find is that with conventional approach, the model specification used in previous studies, we don't really detect any association between sea level rise exposure and to the property prices. But once we incorporate coastal risk factors, then we start seeing the impact of sea level rise exposure. So here, you're looking at the result of the regressions where the top row, on-site disposal, what it means is that if the property has cesspools or other on-site systems, that tends to discount the property values. flood zone, whether the property is in the flood zone, FEMA zone or not, that doesn't seem to affect the property price. Waterfront properties are priced higher. And then the sea level rise exposure, that has a discount close to 20%. And then you can see that those sea level rise exposed properties, if they have seawalls, that tends to offset the negative effect of sea level rise exposure on property values. And also, if you are a neighbor to seawall properties, that's a big, there's a negative big impact on the housing values. And our estimates are a little on the higher side compared to what's found in the existing studies, but within the range of what might seem to be reasonable. And here we see that so passive flooding, so the NOAA sea level rise exposure measure, that is associated with a negative discount on housing prices. But annual high wave exposure, that is also associated in a negative direction. So not just the average, but seasonal fluctuation matters when it comes to the effects on property prices. And in the interest of time, I'm going to skip what we find with NOAA measures, are largely consistent with what we find with other measurement. And we also see that, well, depending on how we set the sample period, for example, if we set it to 1994 to 2000, well, that's when people were not still talking about the effect of sea level rise on properties. So we see that, if anything, sea level rise exposure is positively associated with property values. So we see that probably this might indicate the fact that over time, both researchers and land homeowners, they have started taking into account the effects of sea level rise risks. Okay, so future potential losses due to sea level rise. State of Hawaii Commission on Climate Change indicate that if sea level rise takes place in the future, that's gonna damage about $19 billion worth of properties on the island. But what we find is that in addition to those future impacts, already we see the impact of sea level rise on property prices in the order of $4 to $5 billion based on point estimates on the island of Oahu. And that's some sizable impact on the property tax revenue as well. Okay. So implication to manage between. But first of all, this estimate is going to affect the size of funding that the government would need to think about if it is to implement some buyback or compensation schemes to implement managed retreat. We also see misalignment of private and public interest with shoreline hardening. So private landowner might want to set up seawalls to protect itself, but clearly we see that that's bad for the neighbors. So that must be strictly enforced. And the on-site disposal systems, such as cesspools, well, there are many of those, unfortunately, on the island of Oahu. And there's a legislation to replace those cesspools by like 2050. But then the question is how and where. If the property is exposed to sea level rise, then simply converting cesspools to something like septic tanks may not really solve the problem, right? Because as long as the area is inundated, well, that's going to be has a negative health impacts. And so that indicates that initiatives such as managed retreat must be designed in coordination with those other types of like water and infrastructure management for it to be effective and cost effective in addressing climate change risks. Okay. So I think that's it for the, this is funded by our NSF project with McKenna Kaufman as a principal investigator. Yeah, so thank you very much.
Thank you, Nori, and thanks to all our speakers. Really diverse and fascinating presentations. I'm not going to try to summarize or do any takeaways because we only have 13 minutes for questions. So let's get right to it. And again, just a reminder, let's try to not have everybody answer each question. Just, weigh in if you have sort of particular points you want to try to make ideally quickly. So first question we're going to take is from Tess Stofinger. She asks, are there any examples of quantifying benefits of resilient design features to shorten the return on investment period? Also, have you come across any cases where resilient features are value engineered out to lower costs? So Mónika, maybe it makes sense to start with you for that one, but others may want to, if anyone else has something real salient, feel free to jump in too.
Sure. So the answer to the first question about examples of quantifying benefits of resiliency design and shortening that ROI period, the examples where I have seen it is making sure you do the correct cost benefit analysis, bringing in both tangible and intangible values, right? So often the CVA is not done correctly and not all of the costs are incorporated, especially those costs that are hard to quantify, but you can still do some sort of quantification, such as, the health of the occupants, the how the operation of the community around you. You guys may be more knowledgeable about those cost benefit analysis, but I often see that those cost benefit analysis include only what's easy to put a dollar value to. So really you just have to think about it more comprehensively. And to the second question regarding, have you come across any cases where resilient features are valued engineering out to lower costs? Yes, unfortunately, we have come across many examples like that. And it's not to fault whoever is making the decision. Sometimes the reason is there's just no funding for it. And that's where sometimes the solution needs to come from different entities with private, public, federal policies, state policies. But yes, I have unfortunately seen many cases like that. Hopefully, as time goes by, there will be less and less.
Okay, I think if one other speaker wanted to jump in there, they could, or we can move to the next question. Okay, let's move on in that case. Joel Smith poses this question. Is there an inherent conflict between the desire of residents to hold on to their properties and the need for planning for and implementing retreat? How can legal and funding mechanisms address this conflict? Okay, who wants to take a stab at that one?
I can take a stab at it.
That'd be great. Please.
I mean, I'm guessing that's going to be highly contextual based on the location and the situation as to, whether you're trying to protect land values in the tax base and things of that nature, or whether it doesn't make long-term sense there, and whether there are adaptation mechanisms that work. But I think there are, like I've seen at least from some work done, I think in Rhode Island around that, where the state of Rhode Island had done some work around looking at coastal risk in some of the communities there and updated FEMA's model around specific dune conditions and things of that nature, and recognizing that FEMA's models were underestimating what the likely damage would be. And the coastal communities didn't want to hear it because no one wanted black flags on the properties. The property values go down, the tax base, the local people, policymakers didn't want to hear it. And so that's a barrier. But I'd be very interested to hear other people's perspective on it too.
Yeah, please, anyone else, feel free to jump in on Joel's question.
Yeah, I'm happy to come in on this. I mean, based on our experience here in the East Coast and with the community that we work with, I think here it's really important that this is not something that is sort of imposed or driven by some national level guidance, but this is sort of community owned. And this is quite interesting because the local authority has been quite transparent and is quite clear on which areas are actually going to be lost. And we had a session yesterday where they changed the terminology. Rather than talking about coastal change, they now want to talk about coastal loss, and making, then sort of building that sort of bottom up ownership and then setting out certain principles and criteria. So here it's a really sort of participatory approach. I mean, it's a pilot. Let's see how it works. It will take a while, but it's quite interesting because you generate sort of an ownership for an issue that you just can't hide. And yeah, it's quite well. We'll monitor it.
Okay. Anyone else want to speak to that question from Joel?
Yeah, I can jump in. So in thinking about how to react to this, I'm drawn to some ideas around like risk perception and thinking about the differences in how different communities perceive risk to different types of floods, both now and how they perceive the rate of change of that risk over time in the future. And I think in thinking about desire, I'm thinking about the word desire. It's a very emotional word, at least I interpret it as that. And I find it hard to decouple the differences in ways that different communities and also community leaders perceive risk and how that leads to a change in what desire might mean to them. So I don't know if that's helpful, actually, just adding a couple of reactions more than addressing your questions. Well, I guess my answer to the first part of the question is yes. And just thinking that it would be valuable, I think, to engage more with researchers in like cognitive sciences, for example, to understand the relationship between that risk perception and desire, to see how we could unpack that a little bit more.
Absolutely. Okay, then if there's no further comments there, let's move on to another question. Okay, so this question was posed to Swenja, so maybe we'll start there, but I think there's room for others to speak too. So in reference to your slide on this topic, Swenja, what one person asked said they'd love to hear more about emerging and innovative finance approaches for resilience and climate adaptation.
Yeah, this is a really good question. I mean, I've been sort of working in this space for some time, and it's still actually quite sobering that we call this innovation when we talk about this, because I actually think that very little has happened. I mean, okay, there are a few examples. Resilience bonds come to mind, and some of them work, but we really, and by we, I mean both industry, private sector, but also the research community, haven't really tackled this question of monetizing resilience and making it work within a financial mechanism. And, I think, again, there are some promising examples, and the question, obviously, then with insurance, whether you can sort of tie those together, that's quite interesting. The approach that I find now sort of most promising is tying in resilience benefits with other benefits. And we call this the triple resilient dividend approach. And we're working on an urban bond in Indonesia, where one of the key focus areas is actually waste removal, and you have some sort of environmental and social benefit that are relatively easy to quantify, and you can create the bond around that. But then you have added to that also, the sort of flood resilience component that is in there. And yeah, we're also playing around with that, but would be great to hear from some of the US colleagues, because I think there are some actually probably more promising innovations at your end. So would be keen to hear.
Yeah, please, let's somebody jump in, please.
I mean, where this has led me, this is one of the areas we've been working with Turner Construction on, is trying to figure out exactly how to do this. And it runs into the insurance impact directly on trying to create the ROI around resiliency. Might not be compelling. We've still got to do that work, but it has led us to some work done by the National Institute for Building Scientists, a sort of pseudo-government organization that's advising policy here, which is basically you need to get the stakeholders at the distributed impacts of resiliency all at the table together and think about some multi-sector solutions as the potential way to engage in this. And so it's kind of interesting that I think we've come at it from a purely private sector angle, and they've probably come at it more from a purely government sector angle, and we're kind of at this point where we've reached the same conclusion that this is going to require a bit more collaborative thinking around these topics and a meeting of the minds. So working on it.
Great. Thanks. Okay. So let's take a question. I apologize, I didn't see earlier, sort of a comment from Lee Johnson. I don't know, Marco, if you'd want to take a stab at this. This question about, is thinking oriented around events as either pre or post event or pre or post disaster actually part of the problem? And is that kind of thinking inimical to dealing with slow onset events? Maybe Marco, if you have thoughts on that, then we could go to Swenja or anyone else who. Yeah.
Thanks, Riley. I'm not sure I have a really strong opinion about this, but my understanding is that what I saw is it's very important, I think, for the community in general to define the temporal scales when we talk about slow versus fast events, quick events. We're looking at physical time scales that we know, like extreme events, sea level rise, decadal time scales, annual time scales, and then extreme events. I don't think we have a grasp still on how we translate this into socioeconomic, financial timescales. What are the tools that we try to develop for the communities? You and Alex, implied something also recently in the blog that you also were suggesting, I think, on the Earth Institute, and that's why also we looked at rentals, for example. I think the temporal dynamics of rental, the market could be more reactive than sales. One thing I didn't mention is small businesses. They go hand by hand in places like Little River with rents, and so I think when it comes to this aspect, one thing that we need to converge in terms of academia, government, and of course institutions and other players is really the time scales that allow us to identify the process and dynamics. And I think it is an issue at this point.
Great, thank you. And then sort of last chance to speak, Nori, I'll go to you. I don't know if you have any comments on this particular point or any other questions that have come up. I'd love to give you the last words.
Well, thank you. So related to the insurance or innovation in financial products, what we find is that, for example, a house that is located in the flood zone that is supposed to purchase flood insurance is not properly valued that way. And this is similar to what other similar papers in the literature find, in that the private landowners may not factor in the cost of flood insurance in a proper way in the market. So that also indicates that there must be a way to be more innovative and creating other types of insurance products to align public and private interest.
Okay, thank you, Nori. We could keep this conversation going. I apologize for not being able to get to all the questions, but I'd encourage our panelists to look through the chat. There's a few questions that I think you can do quick replies to, which would be great. But I'll just say I thought this was a fantastic discussion and a perfect example really of how quickly things are moving in terms of many groups within society engaging in proactive ways, powerful levers, thinking about the climate justice issues front and center. So fantastic session. Want to thank all of our speakers. Want to thank those who helped make this session happen behind the scenes, technical support. And with that, we will break. Thank you very much.